If you really want to know when the Fed's going to cut interest rates, this is the only metric you have to pay attention to.
And that metric is credit spreads, or the high yield bond spread, which is the difference between junk bond yields and the Treasury market yields. As you can see, when credit spreads rise, that usually correlates with a recession. When they narrow like right now, that means financial conditions are pretty easy. Looking at this in TradingView and adding the effective funds rate, as the Fed pauses, credit tends to narrow and the market does really well, similar to what we're doing right now. But as soon as credit spreads widen, meaning that default risk is rising, that is when the Fed starts to cut interest rates. And if we take a look at the S&P 500, that is really when the drawdown starts to happen. Now, we see the setup once again. When the credit spread starts to narrow, the Fed is done hiking interest rates and the market is reaching all-time highs. The gun is loaded and we know what happens next. Credit spreads are going to widen, the Fed is going to cut interest rates, and the market is going to follow suit.